You're watching Stockwatch. I'm Simon Brown. And to unpack your stock-related questions today, Ricus Reeders, PSG Hole in one Ruimsig, Mutooni from Sanlam Investments. Be sure to send your questions via email, stockwatch@bdtv.co.za, SMS 41392, Twitter @BusinessDayTV using hashtag StockWatch. Gents, appreciate the time today. Friday was lots of results out from American banks. Larry Fink and Jamie Dimon, respectively JP Morgan and BlackRock, both talking around potential recessions. Ricus, let's start with you. Are you worried about a recession? And what would be, is recession just as simple as good old-fashioned defensive stocks?
Yes and yes. I don't, I don't think I can forecast whether there's going to be a recession or not. But if enough people are worried about a recession, it tends to snowball because it makes people uncertain about where to put their money, whether it be in their factory or in the market, and it becomes a vicious circle. And in that kind of circumstance, I've been defensive and I remain defensive, and I treat any rally in the markets very suspiciously.
That actually almost half answers one of our follow-up questions. But Roy, recessions, are you worried? I like the point that Ricus makes, that kind of like if you start to talk it enough, it sort of becomes self-fulfilling.
No, absolutely. I think you can even see from the soft data that consumer sentiment indicators, PMIs and all of those are going. You see, previously they were already slowing down before all of this. They're already slowing down. Now they've taken a definite negative slant. So the more people talk about it, the more likely it is. But then also think about it this way. As part of growth, trade is a significant part of growth. And what you have right now since Liberation Day has been a complete halt in significant trade across the world with the biggest consumer economy. So that on its own means less activity, and over time it will come through hard data. So I think it's pretty much hardwired that first you'll have a slowdown, and depending on the rescue attempts that are made, you may actually go into a recession, because we're not walking back what's happened in the last couple of weeks.
Yeah, and I like your point there as well. It might not be a recession, which is technical, but it certainly could be a slowdown. I remember the Atlanta Fed GDP Now data is very much saying that they're looking for negative GDP in Q1 at this point. Let's stay with you there, with you, Roy. The question that came through, JSE, the stock, not the index, is that worth having a look at? Good cash, good dividend yield, and higher earnings as volumes have increased. You must have seen it on both of your desks. I've seen it on Value Trade every day. JSE worth a look?
No, absolutely. I think they've restructured their business really well. They're now in all the product. They're there in. They have got a good presence in all products that are out there. And like you said, the volatility is massive. I mean, there are a couple of days last week where we had 45 billion rand trading, 50 billion rand trading, and they benefit from that. So yeah, I think they're offering value at these levels, to be honest.
Ricus, I mean, we haven't seen the sort of plus 40, 50 billion days. I think it was the NASPAS process unbundling, which almost broke the JSE a couple of years back. Would you be looking at JSE as a potential investment?
Yeah, certainly in volatile times like this, all that trade is just profit falling straight through to the bottom of your income statement. And even if you just take a look at the price graph, obviously, they've moved in concert with the market going weaker, going stronger, but there are no danger signs as far as downward price is concerned. Whereas a lot of stocks over the past 2 days, because we're having a very good day today as well on the market, are merely pullbacks from really oversold levels. The JSE never got to that point, which in itself shows its defensive nature at the moment.
And I want to stay with you, Ricus. You mentioned selling some of the rallies. Great question came through. I bought Apple shares about a decade ago. Back then it was a low teen PE. Now it's a 30 PE. My price is up 5x. With all the worries, and it's now an expensive stock, should I use a possible tariff bounce to take some or all profits? Would you be looking to take profit?
Well, it depends on how big it is as far as your portfolio is concerned, but there's no doubt that it's one of the companies that are getting massively affected with the trade war between China and the US. Now, Trump has blinked twice in a row now. And partly that's because of Apple. I can almost guarantee you Apple coming and saying, well, Mr. Trump, we are manufacturing all of our products in China. You better do something now. Um, so in that sense, they've got Trump support. Um, but if it's a huge part of your portfolio, be aware that the Mag 7 is fast becoming the moderate 7 because of the very high valuations that they are trading at. And whether the company is good or bad or indifferent doesn't really matter. If you're in a high price earning share in a market that is going lower, you will be sold off. So if you've had a good gain and it's a huge part of your portfolio, I would suggest diversifying some of that profit away into something more defensive, which is where we started off
Yeah.
with as far as the program is concerned.
Yeah, a report I saw over the weekend for Apple to bring production back to America, 50 billion, 3 years, and that's only 10% of production. Roy, would you be looking to take some profits on Apple, particularly if you were nicely, 5, 6 times up?
I'd say so. I mean, there's two things that stand out here. They're in the crosshairs of regulation and very inconsistent regulation now. So it's going to be we'll charge the tariffs or we will cut them or we'll make you an exception or something, but it means their future is now directly tied to what the politicians decide. That's not a place you want to be. Like Ricus said, it's you've made enough, you've made a lot of money. It's probably time to start looking around and diversifying into something else that will hold value. Nobody ever got punished or fired for taking a profit. And I think 5x is fantastic.
Yeah, absolutely. I mean, he also says, that it was 6x just a little time ago. But hey, that's markets for you. I agree with you. 5 is still a chunky number. Roy, let's stay with you. Question coming through around Zeda, the car company, not the agri company. Is the opportunity there? The stock looks cheap, and I like their business model. This one, of course, came out, what was it, December 23, I think it listed. Would you be looking at Zeda?
Yes. So that's a car rental company, and the thing about them is when they came out of Barloworld, when they were in Barloworld, they were part of the auto business where they were nicely balanced between car rental and vehicle retail. Now on their own, they become a lot more capital intensive. And you've seen the headline earnings did go backwards. They're very dependent on what happens with tourism and vehicle prices. They're trying to lessen all of that by going into leasing and everything, but the reality is they'll always be highly geared. They'll always be geared to the economic cycle. So I would say, yes, it does look cheap. It's not clear to me what it's going to take for this one to start rallying. So it's looked cheap from the beginning. I think the management team has caught up relatively well to what the market is doing, but there's a long way to get market confidence for that one. So I would avoid it for now.
Ricus, I hadn't looked at that chart in a bit. It popped up on screen, a bit of an ugly looking chart down at around 10 Rand. Would Zeda be on your shopping list on a chart that's going the wrong way, top left to bottom right?
Depends. If you're a trader, you're back at a support level of about, wherever it is at the moment, about 1040, 1050. It's been oscillating between that level since about October of 23 to a high of about 14 Rand. So as with the rest of the market at the moment having a bounce, you might take a look at trading that range. But ipso facto, the fact that they've gone sideways since 2000 and 2003 October doesn't make an investment case for me for all the reasons that Roy just alluded to.
So then let's move on to another stock that came through, again, JSE Momentum. They had good results out a little while ago, trading at discount to embedded value. Ricus' new management team certainly doing nicely for them. The chart was looking good. I haven't peeked at it in the last 10 days or so. Would Momentum be on your list?
Yes, it would. And again, just from a technical perspective, and if you take a look at what company share prices have done in this turmoil over the past 3-4 months, a lot of them have really crashed, if I can call it that. Zeda being a perfect example of going down to levels last, 2 years ago. whereas some have pulled back. The JSE is one. Momentum is another one, where share prices have reacted to the turmoil, but it hasn't broken the uptrend it's been in. It's still above its long-term averages. We've seen the company results come through. There's an underpin to it. And the whole bigger point is if one is in a market that is very volatile or even going down, take a look at those companies which are outperforming, even if that outperform just means going down less than the market. Those are normally the companies you want to be in when the market starts going up.
Yeah, absolutely. Relative rather than absolute. Roy, momentum?
Yeah, I think it offers value. I mean, Risto, who's the CFO there, is probably one of the most brilliant insurance minds out there. I think they've done really well restructuring that business and putting in a whole new strategy. I mean, after the last results, the share price did rally. I think it's one of those that you can follow over time. Like you get in and management will deliver. It will be a bit volatile just because of its size and liquidity, but yeah, there's definitely value in that one.
Question coming through about Remgro. They're having a capital markets day today. Someone was obviously watching the broadcast. They say CEO said he is seeing green shoots in the local economy. Certainly, and we've talked about it a ton on this show, massive discount to net asset value. Roy, would you be looking at Remgro?
Well, I didn't. I'm actually going to catch up with the CIVH presentation later on. I think if you think about Remgro, what you're looking at there is primarily Mediclinic, CIVH, and a couple of other industrials. It had sold off quite a bit. Green shoots, I'd be interested to see which green shoots he's seeing because it's not no one else who's talking about all of these. I think it's a nicely diversified portfolio. I think the strategy of getting experts to run the businesses while you're a silent shareholder can work, but it needs to prove itself. We need to see some progress there with regards to the bigger assets, and also for them to get rid of all of these liquid things that they still hold. That makes us know that they've actually committed to this new strategy. So I think it's in the wait and see, hold, wait and see bucket for me.
Ricus, your take on Remgro. That discount, I mean, if we're waiting for it to close, we might get very old waiting for that. But do you like the chart? Do you like the underlying holdings?
Yeah, it peaked at 160 very recently. It's pulled back to very viable levels. Forget about the closure of the discount NAV. That would be the cherry on top. But I think it's at very viable levels. They had some results this morning from the medical part of the business, and that seemed, turnover up in double numbers. So that's certainly not negative for the company. And they've got a nice spread of assets. I think management has gone stale, but they are doing steps to change that, to change the strategy, to get it a bit more market positive, if I can use that cliche. It's not baked into any kind of result yet, but I think there might be an optimism as far as the forward trajectory of the management of the various assets are concerned. So I think it's fairly safe and certainly technically in a very viable level.
Yeah, I like that, and it is. It's getting sort of market friendly. Market sort of moves in and out of favor from time to time. Short-term insurers. A question coming through. I typically like short-term insurers. There are a couple on the market at this point. Is it a sector worth looking at? Is there a particular one that the panel prefers? Ricus, the short-term space. I like their ability to reprice quickly. Of course, they're also subject to global climate change and all the other bits and pieces. Short-term.
Yeah. Yeah, I mean, the real choice you've got here is Sanlam, and I would imagine they're still pretty okay, even at these levels. Offshore, I haven't really looked into it that deeply, but Lloyd's is starting to look interesting. If we're going back into a mercantilist type of economy, the guys who've got experience in that type of environment is Lloyd's. They are not, they differ and they take on specific risk. And this is what's going, I think, with the diminishing, or in fact, possibly the end of global trade. You need a company that knows how to manage individual risk like they did 100 years ago. So I think that's an interesting angle as far as short-term insurance is concerned. But I mean, this is just my initial thoughts on the company.
Yeah, so long story short version, my granny's neighbour about 100 years ago had a Lloyd's name and they used to send her a cheque every quarter in pounds. It would be like £10 or £40, but living in Durban 100 years ago was big money. Roy, short-term insurers?
Oh, absolutely. I think both Outsurance and Santam are very well positioned in their respective markets. I mean, Santam's huge in the underwriting market here, very well experienced, solid market share, and they keep finding ways of growing. I mean, clearly there's the conflict of interest here that Santam
Sure,
is
sure.
owned by Sanlam, but that said, I think it's a company that's operating incredibly well. Outsurance on the other side, done well in Australia, done well here. Their business model just keeps growing and widening margins. I think they have the best industry margins there are out there. So both of them are quite solid. I think they both continue to offer value here.
Yeah, and of course they're looking at Ireland. Well, they're going to Ireland, but they're going to Ireland carefully, which perhaps is the key point there. What about capital appreciation? Question coming through around that. I got to say, I like their point of sale business. Their ITC, I'm never that convinced about. Roy, it's a tiny stock. Is it one that you ever look at?
Yeah, I look at this every so often. Like you say, the payments business definitely looks interesting. The IT side is very stop-start. Every so often they seem to get things completely wrong or get them completely right. I don't think they've got the motion quite right, but I think that payment system can actually give them an edge. But that said, remember, everyone's in payments now, from the mobile
Yeah.
players to the banks to specialist software people. So it's very competitive. You have to try and get your edge. Again, this is another one that I think I just watch every so often to see whether there's any significant breakthrough, which I haven't seen yet.
Yeah. Ricus, capital appreciation?
Yeah, I agree with Roy. 4 or 5 years ago, when there were less competitors in the market, it was looking very, very interesting. But I'm worried about whether they have um, the size going forward to compete favorably. Um, but as with all these small mid-cap companies, they either become big players or they get taken over or go bankrupt. I don't think there's any reason to think they're going to go bankrupt. I'm worried about that they might not have the size, but they could become quite an interesting takeover target because of the IP they have already.
Yeah, no, that's fair. And they got some good IP there. Although my physio used to use one of the small things, and now she just uses it's an iPhone or maybe it's a Samsung. It's now built in. So, I mean, part of your competition, as to what you both say, is actually not even the mobile operators, it's the telephones themselves. Question around clothing retailers. Been selling off since late last year, offering better valuations. I'm looking at Mr. Price. I'm looking at the Fashini Group. Should I dig deeper or should I look away? Ricus, would you look away from either, or do you think there might be something here?
My preferred stock there is still Pepcore, basically because of their branching into fintech. And I'm worried about any company that's highly dependent on complex supply lines at the moment. So it depends on where you're going to source your clothing from. But so Mr. Price and Fashini, although they are the bigger names um, on the market, rank below as I said, my own choice of Pepcore.
Roy, what would be your choice in the clothing space, or is it a look away space for now?
Yeah, no, I agree with Ricus. Pepco is definitely well positioned. That IT space is growing really well for
Yeah.
them. They've created the market. They've got a footprint, and it's doing well. They're also a cash retailer predominantly, so that's a lot more defensive than the guys who have to lend money. The thing is, for both Truworths and Foschini's, the share prices have sold off quite significantly. They're trading well below their long run averages, so maybe it's worth a look into. But I think Ricus brings a very important point there. We're not clear about what complex supply chains will do to the ability to price and sell into a depressed market.
Yeah, and that's actually a great point from both of you. Supply chains are changing, and we're not quite sure how or where they end up. The question on banks coming, everyone likes the Standard Bank, everyone likes the First Rand. ABSA to me looks significantly cheaper than than the other big banks. Roy, would it be ABSA or is it just? I mean, Standard Bank and First Rand are typically the two sort of standouts on what they do, but ABSA's the valuation play, perhaps.
Look, ABSA is always the cheapest. So when you look at it on a relative basis, historically, they've always been cheaper. And that's because they've had all of this turmoil. When Barclays left, they weren't lending and they were the biggest retail bank. So all you've seen is market share drift, actually all the way down. So there's a lot of work the new CEO has to do. He needs to install a new culture, needs to turn around the retail bank and build it up. So I think it's cheaper than the others, justifiably so. During times such as this, you probably want the quality franchises, which is probably Standard Bank and First Rand, and just never discount Capitec, to be honest. The growth in Capitec has come at the expense of ABSA. Because a lot of their clients did move that way. So no, I don't think you can discount any of those three. But I would say for now, ABSA should be a discount to the other solid franchises.
Yeah, I tried to get some Capitex below 2,500 last Monday, but my fingers were not fast enough. Ricus, banks, ABSA, Capitec?
Roy mentioned something interesting a few weeks or maybe a few months ago, and he described Capitec as becoming less of a bank and more of a platform. And I think by that, and tell me if I'm wrong, Roy, you meant something like Visa, in other words, where it offers financial services rather than just banking. And I think people say Capitec is overvalued, but then you've got to start comparing them with things like Visa or MasterCard, possibly. So that's an interesting if you want to talk about the banking shares listed locally. As far as the others are concerned, I don't want to be in something that's restructuring in the middle of an uncertain bearish market. So ABSA's out for me. That leaves us with basically Standard Bank and First Rand. First Rand, still worried about what's going to happen with the the motor financing court case that's happening in the UK. I'd like that to get out of the way. So the obvious one that remains would be Standard Bank.
Yeah, okay. And I remember, Roy, your point. And it is, and apparently they're the biggest seller of data and airtime in South Africa outside of the telcos to their 20 plus odd million customers and are doing huge there. Let's go to stock picks. We've got a few minutes left. Roy, you're going with Bytes.
Yes, Bytes. So Bytes was unbundled from the Altron Group. It has no operations in South Africa. They're basically a UK software services provider. They're an agent for Microsoft. During difficult times such as these, the advantage of someone like Bytes is they charge the same way Microsoft charges you. You have a subscription every month they collect, negative working capital, no one ever cancels. I think a business such as that in an industry such as that is nice and defensive in the world that we are in today. So yeah, my pick will be Bytes.
Yeah, and earning sterling, and nothing wrong with that. Sterling was almost 25 to the ZAR last week. Ricus Reeders, McDonald's, which reminded me I need a chocolate milkshake because they do make the best. But you're going for McDonald's.
Yeah, look, I mean, this is a global company, so you've got your geographic dispersion already in place. It's a consumer cyclical, but it's not that, it's got a beta of about 0.5 or 0.6. So in a certain sense, it's defensive. It's got complex supply lines, which is what I'm against. But on the other hand, they already source a lot of their ingredients locally. So they've got both, if one takes a look at what companies to invest in, go for things which are not really affected that much by where you get your stuff from. I mean, their biggest problem with chips is where they get their potatoes from, rather than whether there's an embargo on tech shares in China. So it's nice and offensive. It's been spared the absolute markdowns we've seen in the US markets. And and I think despite, as I've said, being a luxury item, it is far more defensive than most of your other consumer cyclicals.
Yeah, and I like your point. It's complex supply chains, but they're going to be internal. You're not buying your potatoes from the other side of the world. That just makes no sense. You might be buying it from a different state, but that's nice and simple. That's all for Stockwatch today. Thanks to our guests, Ricus Reeders, PSG Hole in One, Ruimsig, going with McDonald, Mutooni from Sanlam Investments, going with Bytes Technology. Up next, the close. Stay watching.